the risk managers on Supply Wisdom's Risk and Resilience team. And we wanted to come and talk to you, our customer base, a little bit today about your concerns surrounding the recent banking collapse for banks such as SVB, Silvergate Capital, and Signature Bank. Obviously, as clients who rely on third-party providers and rely on outsourced banks, we understand that this news may have raised concern for your business. So we want to take some time to dig into what are the root causes of that collapse and what can you as a third-party risk organization do to shore up your business for any such events in the future. So first and foremost, talking about the causes, as we've done a review, there's quite a few key areas that keep coming up on the topic chain. And I don't want to spend too much time on this because I know that everybody's been dissecting these issues ad nauseum, but we can really pinpoint three primary areas of concern that ultimately led to the downfall of these particular organizations. And the first one is lack of diversity in the portfolio, which led to significant losses of capital. So if we look at SVB, it was their overinvestment in treasury papers. If we look at Silvergate Capital and Signature Bank, it was their overinvestments in an unstable crypto market, and how that led to catastrophic losses in their ability to provide customers with access to cash and capital. The next area is lack of oversight and risk governance. Normally, with larger banks, you would have a risk governance structure and a regulation structure that is forcing scheduled stress tests, causing them to track liquidity, and those types of factors were all missing and absent from this particular situation, including but not limited to an almost year-long absence of a chief risk officer at SVB. Something that should have been a big warning flag for people working within that industry. And then lastly, out of this was the run-on from banks and corporate clients and investors that happened. So once word started to get out about potential losses, about concerns of cash liquidity, more and more investor partners, customers, and things of that nature started to withdraw their assets. And that caused a run-on of the bank, which led to ultimately the final collapse of this particular organization. And so what we want to talk to you about today is some real tangible actions that you as third-party risk managers can do and perform within your organization to help prevent and mitigate potential for these kinds of concerns in the future. So the first thing that we're recommending is that you ensure that your company is tracking its banking, investment, and deposit concentrations to maintain an accurate overview of your own liquidity risk. You should be evaluating your own internal exposure to potentially vulnerable and risky banks and begin continuously monitoring them so that you can track and predict any such incidents as this in the future. The next area is adding financial liquidity to the metrics that you're tracking in your assessment and ongoing monitoring process. We would say that you should consider reviewing your third party's financial statements for cash flow availability and ascertain whether their cash reserves are sufficient to weather potential disruptions or crises. Cash reserves are going to help ensure that the business has necessary resources to cover operating costs, meet their financial obligations to you, their customers, and if they experience a temporary cash flow shortfall, you'd be able to ensure that there are assets backing those reserves that ensure that you're going to get your money. You should have conversations with your banking institution about their policies around investment portfolio diversity to ensure that no singular shortfall in any of the financial industries is going to ultimately lead to the collapse of their institution and a non-return on your investments. Additionally, we recommend that you look into operational risk assessments The lack of operational risk assessments contributes significantly to SVB's downfall. The absence of a chief risk officer was only one of the critical operational risks that have come out as we begin to dissect what occurred internally at that bank. By conducting regular assessments of third-party vendors' operational risks, businesses can ensure that they have adequate management practices in place that are ultimately going to protect them from potentially catastrophic events. So review your bank's resiliency policies and ensure that regular scheduled stress tests are being conducted. Next, we would recommend that you review insurance coverage. Reviewing your third party's insurance coverage can help the business identify gaps and ensure adequate protection in case of a crisis or other risks such as cyber attacks, malware, things of that nature. If you're reviewing your third party's business interruption insurance and cyber insurance while assessing their coverage limits, deductibles, exclusions, and other policy terms, you're going to ensure that there's appropriate amount of protection in place for you and your organization. And lastly, we would recommend that you, as a customer of these banks, review your exit strategies and maintain lists of alternative suppliers. Ultimately, you as the buyer have the power of where you decide to take your business. And if you see red warning signs on the wall, you and your organization should be prepared to extricate yourself and shore up your losses.